So did you read? I was looking the other day, yesterday in the journal, they had a story about people buying real estate in the metaverse. This
Yeah,
company,
it's incredible.
this company, Republic Realm, said it paid $4.3 million for land in Sandbox, the biggest virtual real estate publicized to date. 4 million bucks for real estate in the metaverse. Wow.
I know. I know you're on the coin side that doesn't like crypto and all this stuff. I'm gonna take the other side, man. I think we're early.
You're gonna buy, so you're looking to buy real estate in the metaverse. Forget a house in the
Oh,
real
no,
world.
no, 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 no. You see, you take it to this extreme. No, I'm not trying to friggin' buy property to develop in a place that doesn't exist. I'm saying that Web 3.0, Web 4.0, tokenization of services, tokenization of media, cryptocurrency, all that stuff. I think without a doubt, 20 years from now, it is a massive part of our economy and how we interact with each other.
Yeah, I just don't know if it'll be Bitcoin.
I can't wait to own a high rise in the Matrix.
Oh, I can definitely wait. I'm not interested in being like, oh, great, there's like a Times Square parcel. It's available in the metaverse that I can buy and just put down an establishment there because I don't want to be in the metaverse.
Yeah, do you get a dystopian thing from this? Is that how you feel? Or this is how the future works?
Maybe it's me and that sort of like I'm now becoming that old man that's like, I don't want this new world that we're going to. Like, I don't want to be visiting you in the metaverse versus visiting you in real life.
And away we go. Welcome to Talk Your Chart. My name is Marco Segura, here with the incredible Red Horowitz. Red Horowitz, hope you had a great Thanksgiving. Let's jump right into this today. I'm going to go first, and I want to talk about the idea that the market is forward-looking. This comes up a lot in conversations with clients, and most recently it came up in a conversation that I had this past Saturday while I was celebrating my birthday. I am now 34 years young. I've completed my 34th rotation around the sun. And people asking questions about the beginning of COVID and different inflection points in the economy and in markets, where they were saying the economy is telling us and signaling us one thing, but the market is doing something else. And I think a lot of times that can be explained away with this single statement of the market is not looking at right now, the market is looking at what's to come. And the chart that I wanted to start with today, and I broke, I think it's a rule that I set that I'm just constantly breaking all the time. I have 3 charts that I wanted to show everyone today. I think they're very helpful. And the first one I want to show, which is a little bit more focused on kind of what's happening right now in the whole COVID times, has to do with 4 individual stocks, specifically Peloton, Planet Fitness, Live Nation, and Zoom Video, right? If we're doing a who's related to who, I think we can all agree that Peloton and Zoom are these kind of COVID companies that have done very well because they're very virtual, perfect for a socially distanced economy. Planet Fitness, Live Nation, quite the opposite. No one was going to concerts. No one was going to the gym. So the chart that we're looking at, however, is starting October 1st of 2020. And BH, since October 1st of 2020 up to now, I asked those people on Saturday what they thought the performance of these companies would be. And as you probably guessed it, they were as wrong as you could have possibly been.
Yeah,
And
I'm sure they guessed that the stay-at-home companies did the best because that's what you'd say is sort of, even though we've gotten back to things, back to normal, there's still a lot of people that are not doing that normal stuff. Still a lot of people that are nervous. You hear it all the time. We have more and more cases, more and more variants. So they would have said, yeah, the Zooms and it would do horribly, and the Planet Fitnesses and Pelotons would do great.
Yes, and that was someone's immediate response. And then I got 2 more thoughtful responses of people that are a little bit more plugged in. And they said, well, given the run that Zoom and Peloton have had, I'm sure they haven't gone up too much since then, but we expect that they would be doing at least as well as these other companies, right? And then when we kind of look at it, look, number one, stock picking is hard, right? Is it possible? Yes. Is it probable? No, right? Picking winners is tough. But look at this. You have Peloton and Zoom down over 50% over that period of time, while the other two have recovered meaningfully at almost 100% returns for Live Nation and just shy of 30% for Planet Fitness. Why did this happen? That is because, we'll say it again, the market was looking forward. October, right? What were you doing for Halloween in October of 2020? I didn't go trick-or-treating.
I had unfortunately half a bag of candy that I gave out last year. This year was like 18 bags. Last year was like half a bag.
Precisely. Why? Because people were still shuttered.
But Marcos, it's not as if no one's using Zoom now or no one's using Peloton, right? We're still both Peloton users. We still use Zoom in the office. Lots of clients still want to have meetings via Zoom. Not like no one's using those products and they've gone from everything to nothing. They're still utilized a lot.
Oh, absolutely. But there's a difference between a company and its stock, right? And that's precisely what's happening here. And it's also expectations. Once you set really high expectations, very hard to beat those, right? And Zoom and Peloton had issues with that, on top of the fact that Peloton is meaningfully not profitable for now. So anyways, back to kind of the high level point here that I was trying to draw to them on Saturday is the market didn't care what was happening in everyone's minds and behaviors in October. They cared what was going to be happening over the next several months as vaccinations rolled out, people got more comfortable, treatments were better in hospitals, and people's natural feeling of safety just increased. The market said, we need to properly price that in. And these, I think, are 4 companies that illustrate that wonderfully. I will quickly touch on the other 2 charts that I brought up here. The first one is the great financial crisis, right? Which some may remember, some may not, but that was a market that was down just about 50%. And what we're looking at in this chart is the bottom of the market, of the S&P 500 in this case. No, I'm sorry, of the total stock market. This is actually an ETF, an exchange traded fund that you can invest in. The bottom was March 9th of 2009, before the unemployment rate even peaked during that recession. But for some reason, March 909, the market decided there's no looking back. Sure, you get your volatility along the way, but you can clearly see a trend forming. That was the moment that things have turned. And then let's go more recently to the third chart, which is COVID. What we're looking at here, the same 2 factors, just a different time frame. This is from January through November of this year. You see, again, the market bottomed. Unemployment hadn't peaked yet. And then, of course, what happens? You get crazy stimulus, and you realize that perhaps this was oversold for a market that's going to be given all the stimulus. So again, if you're waiting for the dust to settle, if you're waiting for the sounding bell of when the bottom's coming, you're never going to hear it. And if the headlines are already good and the headlines are positive, you've most likely missed out on the meaningful part of the recovery. So for me, the signal here is don't wait, get invested.
We hear it all the time from clients where they call up and say, I'm nervous because of what the media is telling me today. Or I'm excited because what the media is telling me today. I'm nervous because of X, Y, and Z. This is what's happening right now. But to your point, what's happening right now is not even that meaningful, right? Because I think what people saw while the companies like Zoom and Peloton ramped up and did phenomenally in the early parts of COVID, I think the stocks went up so much that people were in the idea that it would continue forever, that they would make more and more money and have endless amounts of new subscribers, and that we'd never go back to where we were, which isn't possible.
Precisely.
When you think about all the risks that we have in the economy now, it doesn't matter what's happening now. It doesn't matter that we're going through situations now, because those will get resolved. And so what the market, as you said, is looking ahead and saying, eventually these things will change. Eventually we will go back to normal. And eventually we'll be dealing with other things that we don't know about today.
Yeah, I think that's well said, man. And I don't think there's much more to add to it. I think right now we're looking at like a 5%, 5-6% drawdown in markets right now. And people are worried. I think you love quoting the 66 all-time highs this year, right? So we're still treading plenty above water. So then that would be the question, oh wait, so is it a bad time to invest because things are so expensive? Once that reason goes away, there'll be another reason why it's a bad time to invest. We always know it. The moral of the story, markets are forward looking, invest your money, equanimity, no off the cuff reaction. That's what investors can do to best serve themselves and their families.
Well,
What do you got?
What this also shows me, I think it ties into the charts that I'm going to share, is that be able to time this, to be able to have gotten into those couple stocks that did phenomenally during early COVID, and then have gotten out later in COVID, as you said, before things actually changed all that dramatically, and to have timed that well, to have gotten in the low point, gotten out the high point is so difficult.
Precisely.
And so what I'm going to talk about is persistence. And I thought about this during Thanksgiving because my wife and I have a dog, Jackson, and he rarely gets fed from the table. But every time we have Christmas and Thanksgiving together with everybody, he goes around to each person, puts his head on their lap, stares at them with his big brown eyes, and asks basically, can I get some table scraps? And we never feed him, but he is persistent enough to think today is the day that this is going to be successful, even though it hasn't happened in the last 365 days. I don't know if your dog get table food, but.
And that hope, persistence. I don't feed my dogs at the table. Everyone else does. It's a thing in the house.
So these dogs, for every single day, get told no, but they keep trying because the idea is maybe at some point I'll get lucky and I'll actually get some food. That's persistence.
Yeah. But also dogs, hardwired to just want that food.
Yeah. Contrast that now to something that the S&P puts out twice a year. They put out a scorecard. They call it a SPIVA scorecard. And I love looking at them. This one's out a few months ago from mid-year 2021. And it's their persistence scorecard. And what it basically shows is how many funds, we can look at funds in two ways. Active funds, right? Where a manager is saying, I like this stock, I don't like this stock. I'm going to be very nimble and try to do time when I want to get into stocks and not. Versus the passive stock, just going to own the entire stock market. Our company is very passive oriented. Most of our funds in the stock side are passive, like the S&P 500 or the broad index. But a lot of investors think they need to be active. You think, wow, this is a great time to be getting into those stocks or getting out of those stocks. And so SPIVA put together this chart that shows how many funds that are active. And by an active fund, we're talking about where there's a manager that's basically, you're paying them an extra fee to try to beat the index. This is their day job. This is what they do all day, every day. And of this, they looked at funds that were in the top quartile through 2019, June of 2019, and how many of those were repeat offenders, meaning also top quartile funds in 2020 and then 2021. And while a lot of them stayed that way for next year, still top quartile, S&P found that a mere 4.8% of funds that were in the top in 2019 remained that way a couple of years later. And so their summary was, while the persistence report does not prove that fund performance is completely random, from a practical decision-making perspective, it reinforces the notion that choosing between active funds on the basis of previous outperformance is a misguided strategy.
So, Brett, if you can't drive looking in the rearview mirror, right? If you can't make forward-looking decisions, looking backwards, how do you make decisions?
I think number one, you stop paying attention to the Jim Cramers of the world. You stop paying attention to CNBC. You stop paying attention to the newsletter that your friend sends you about here's what's going to happen in the future, because the reality is no one can predict the future. We don't know what's going to happen. And so many clients come to us over the years with stock ideas. Hey, I want to own J&J and Pfizer and Moderna because of the vaccine. I want to own this and that because everyone's doing it. And the reality is you're probably late. And if these guys who are professional can't do it, I don't know why you'd expect that you or I or somebody from the newsletter who's selling you the service can beat the market. So that's my first piece of advice, is stay away from those.
I agree. The only thing I'll bolt on to that is we're in a human business, right? And it's naturally human nature to kind of pay attention to what might be a flyer, right? Just because there's an itch, you want to scratch it. And I think you'd agree with this. when we approach it as planners, and I hear you, don't do it, don't do it, don't do it. But I'd kind of adjust that or massage it to say, not necessarily don't do it, but do it in a risk adjusted fashion. Meaning properly size that position so you're not financially fragile if it doesn't go as planned. Sure. And what's interesting, and this I was able to dive into this more recently with a client conversation, where they thought the downside we were trying to protect was basically this stock that they wanted to buy going to zero, just disappearing off the face of the planet, which is not necessarily what we're worried about. What we're worried about is that in order to achieve market returns, that again, we're not supposed to look backwards, right? But let's look back a little bit. 1926 to end of 2020, markets averaged 10% roughly. Our issue is that over the next 20 years, the returns that you need to earn in order to sustain your lifestyle and living standard are not going to be found in any one individual stock. So maybe that stock's still around, but it's up 20% over 20 years, as opposed to the market that's compounded at 2,000%. So you end up in a position where, wait a second, it didn't go bankrupt, it didn't disappear, but man, it just underperformed the market by a long shot. And that's usually what happens, right? And we have the studies that show individual
stocks. There's a lot of risk too.
Yeah, precisely. Yeah. So that's the issue.
I heard a quote the other day. It said, instead of looking for the needle in the haystack, which is basically what we're doing here, trying to find stocks that or funds that 2 years later are still in the top, instead of looking for that needle in the haystack, just buy the whole haystack, right? Because your needles are in there, right? The stocks that have done well are in the S&P. The stocks that are not are in the S&P. Everything's in there. And this is why Vanguard's so popular, because it's not about the fact that it's just sort of random stock pickers sometimes do well and sometimes don't. There's such strong research over the last 10, 15 years, stock pickers do horribly. And so this is why Vanguard has been eating up the share, because they're cheap and because they outperform.
Yep. And I'm going to do one other thing, not to take the other side, but I'm going to defend the active fund managers a little bit here. This is not to say that those people are not intelligent, not well-versed, don't understand what they're doing. The problem with active management is the costs.
Right. Right.
If you do gross of fees, if you record performance before their fees, these guys, these girls do up meaningfully better than what the recorded numbers are. And they're actually more persistent and consistent than you would think. The problem is you don't take home gross performance, right?
Right.
You take home net performance. And the reality is it's just too expensive from a turnover standpoint, from a tax implication standpoint, and from hey, you got to pay these warding guys and girls a ton of cash in order to be the face of a fund. So
or do it yourself, not pay somebody a fee, in which case doing it for half an hour a day or doing it for a couple hours a month, or thinking that you're going to outperform somebody that does it all day, every day for the job. I just think it's laughable.
Now, it'll be fun 5 years from now, because there's plenty of people that have left their jobs to go be stock pickers. We'll see how those people do, right? Oh, Robinhood. Wait, before we leave, let's look at Robinhood's market cap. We did Peloton. Peloton went from a high market cap of 50 billion down to 14. Hello. I think Robinhood had a big dip too. Robinhood from 40 billion to 20 billion.
And they had a ton of accounts were open in the initial part of it, right? I mean, everyone was opening accounts to just trade everything, because you could make money basically throwing a dart at a wall. Any stock was up significantly last year.
No chance. All right, BH, persistence. Get that poster on your office, persistence.
Talk Your Chart episode number 10 in the books.
Thank y'all. Peace.